Before we jump into this episode, I want to invite you to join our community to help you become a better steward, scale to billions, and ultimately give more or all of it away. All I want you to do is to click the subscribe button right now. I love your support. It's incredible to see your comments, and we're just getting started. I can't wait to go on this journey with you. Thank you so much for subscribing. It means the world to me. Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. My name is Brett Swartz, and I'm joined today by Glenn Hanson, who's got an amazing, incredible background. He's the CEO and founder of Colony Hills Capital LLC. In the greater Boston area, and he's a seasoned private investor, entrepreneur, and boasts 4 decades of adept leadership and steering thriving ventures. And he's got an amazing background. And today we're going to be talking about basically why operators should stop defaulting to 1031 exchanges and start offering a more flexible exit path with the deferred sales trust. Quick background on myself, our company Capital Gains Tax Solutions offers deferred sales trust for clients that are exiting Bitcoin businesses, real estate, and have large, massive capital gains taxes. But Glenn, you know, one of the biggest challenges is that people get stuck in these 1031s, or they get in these positions of trying to put deals together, but the tax dog sometimes can sink the ship, right? And it can hurt opportunities and deals. Maybe we can start with a little bit of your background and your expertise, and then kind of dive into that deal story that we were just chatting about.
Sure. Yeah. Actually, talk about my background. You went back 4 decades. I was reflecting on that just the other day, and I got my pilot's license back then, and it really helped steer my businesses to a more successful conclusion. And if you ever think about it, manufacturing scrap rate is allowed to be, if 1% or greater is your scrap rate, it's okay, right? And if you think about in the United States, there's 3,600 planes in the air at any one time. If we had a 1% scrap rate, we'd be losing 30 planes a day. And why is that? How is it possible that the airlines can do and function at that type of quality control, and we in business sometimes miss the mark? And I bring that up because you started with 40 years ago, and that's driven me to always look for solutions to keep us from crashing, right? So when I think about the 1031 exchange today, I have clients that come to me with 1031 money, and we can't help them because we can't identify the deals fast enough. And so I wanted to reach out to you guys, Brett. Having met you a couple of years ago, followed your success, and it's neat to get caught up a bit, but I wanted to just try to understand how I can utilize 1031 to help my clients, and of course that benefits us because we become a resource for them. And when we first met, and you talked about 1031, or you talked about the tax gain solution that you have, it wasn't something on my radar, and I'm not sure that you had fully baked the way to manage it. So I'd really like to dig in under the hood and see what have you figured out so that we can transfer those people over to you, and you can satisfy them, and then hopefully they'll invest more with us.
Absolutely. And I think it's good to start with like the problem, right? The problem is obviously a big tax bill. The other problem with the 1031 is a short time frame. And the next problem is it doesn't give you an opportunity to diversify or to dollar cost average or to really have the liquidity, right? And we're seeing some of these things come into picture right here. I mean, think about why some of the deals, especially in multifamily mobile home park, haven't worked out. Well, people bought 2021, 2022, and they likely or could have overpaid at that point. A lot of it because of the 1031 driving values, right? At that point too, cost seg and bonus depreciation, another tax tool that was increasing the valuations of properties because people could bonus depreciate. That's also coming back this year as well. So understanding that tax flow and tax deferral incentives often drives value, and it can be inflated value. Now, no one knew what the interest rates would do, at least to the extent that they did it, doubling. That's kind of hard to predict. But still, just think about that. If we had a crystal ball, we can go back to 21, we could probably say, this is pretty high. 22, this is probably pretty high, or this might be the peak, at least close to it. you know, we were in this bull run of, you know, 10, 12, 13 years of the market, right? And then, you know, there's typically corrections, I think around year 10, 8, 9, 10, maybe, you know, anyway, so you look at this and you say, okay, what could we have done? In a perfect world, you would have sold everything. So if you like this little short clip of the interview I just did, click over here to watch the full interview. And please don't forget to subscribe. Thanks so much, everybody.